Good morning. Welcome back to Breakfast Television. Time now for Dollars and Cents. We're continuing with our mortgage makeover series, talking a little bit about different topics relating to your mortgage to help you out with making some decisions. Today, we're going to be talking about the benefits or downfalls of refinancing your home. And here to talk us through some of those questions, once again, is Brent Parnell, mortgage expert. Thank you so much for coming.
Yeah, my pleasure.
Always good tips when we have you here. Now, it can be a scary thing. You hear the term refinancing, and some people, especially if they're first-time homeowners, might go, how common is it? Are we seeing that start to happen more and more?
Yeah, more and more these days we are seeing people look to refinance, and I think it leads to two things. One is interest rates are at historic lows right now, so it's if you are borrowing money, it's probably one of the best times in history to do so, and as well, real estate values are at an all-time high. So, you may have a customer who's been in their house for the last 6 or 7 years, and the housing values have gone up substantially, almost doubled in that period of time. So with low borrowing rates and high valuations, it leads to a lot of equity and some opportunities for people to access some of that equity for refinancing.
Okay, so let's talk a little bit about that and sort of explaining for us what you can use your home equity for.
Sure. I would say the most common thing we see people using their equity for these days is refinancing to consolidate debt. The average Canadian probably isn't saving as much as they used to or they should. And in turn, has a little bit of debt maybe on a credit card, car loan, line of credit. So we see a lot of people who like to consolidate that debt, put it all together into one nice mortgage payment, lowering their monthly payments, lowering their interest rate, and basically freeing up some cash flow on a monthly basis. So it can definitely be beneficial for a lot of people. The trick is, what do you do after that with the savings? So most of our clients, we counsel them on taking that savings, maybe getting some type of a savings account set up, talking to their financial planner about what to do with that money and making productive use of that savings.
Okay, so some really good information there. So the benefits, you kind of already touched on them, but just let's walk through a little bit more about the benefits then.
Sure. I mean, the big thing is with mortgage rates being, let's say a 5-year fixed rate right now is under 4%. Most people probably borrowed money in the last few years around 4, 5, 6%, and with credit card debt at 10 to 12%, there's some substantial savings by basically lowering your interest rate and lowering your monthly payment, putting some cash back into your pocket.
So what's the substantial? How much could people possibly? I know it fluctuates, obviously.
You know what? I would say on average a few $100s a month, which can be thousands or $5,000–$10,000 a year of cash back into their pocket. But by doing so, again, you're eating up some of your house equity, and you got to remember to use that for a good cause.
For good things.
Yeah, good things.
Not free money, as we like to sometimes say.
Exactly.
So there are obviously downsides to everything, and let's talk a little bit about some of the penalties, what could go wrong, or what some of the downfalls are.
Sure. I mean, the biggest negative, I guess, is what's it going to cost the consumer to get out of their existing mortgage. And most people, up until recently, thought it was a 3-month interest penalty, which, in reality, a penalty is a penalty, but it's not too bad. There is another penalty that's calculated these days more commonly, and it's called an interest rate differential penalty or an IRD penalty. Okay. Basically what that is it's the interest rate that the bank is going to lose by them lending your money out today now at a lower interest rate. So for example, if somebody has a $100,000 mortgage, let's say their interest rate is 5%, and they want to refinance that today, they have 2 years left on their term. Today's interest rates that bank may be offering, let's say, is 4%. The bank is going to charge them an interest rate differential penalty between the 5 and the 4%. Okay. So for example, it would be 1% based on that $100,000 mortgage over the next 2 years, or $2,000 would be the penalty in this scenario. In most cases, it's a lot higher than that, with people having balances of $150,000, $200,000, $250,000 mortgages. The IRD penalty can be in the tens of thousands of dollars. So it's key, first and foremost, if you are considering refinancing, check on that penalty. Work with your broker as well, because there are ways to alleviate that penalty a little bit, but it can definitely be a negative of refinancing right now.
Okay, so definitely something that you do want to consider and keep in mind. Now, we only have a few seconds left, but can you please walk us through the process quickly, just to sort of explain how it would work? Yeah,
so I mean, the first thing to do, basically, if somebody is considering refinancing, is try to evaluate your house. Okay. Pretty easy to get up to 80% of the equity in the house these days. You can go a little bit higher, up to 90, 95%, but there are some extra costs to doing that. So evaluate the house, find out, determine what the house is worth, determine what the borrowing amount available is. At that point, you can decide what you want to use the money for. It's pretty simple, straightforward from there. You draw up a new mortgage, sign the new mortgage documents with a lawyer, and it can all be wrapped up in 10 days or a couple
wow.
weeks on the quick side.
And there you go. And some savings to be had. All right, good information. Brent Parnell here, once again, our mortgage expert. And we will look forward to seeing you again in our mortgage makeover and dollars and cents in the weeks to come.
Thanks,
so thanks so much for having us, or for us for having you, for coming in. We're excited that you're here. We're
Great
coming
to be
back
here.
after the break with web funding, so you don't want to go anywhere. We'll see you in a couple minutes.